Welcome everyone. Let's kick things off by talking about crypto tax in India. It's a hot topic with some pretty complex layers to it.
Absolutely. It's fascinating how India has structured its tax framework around cryptocurrencies.
Right, so at its core, the system levies a 30% flat tax on profits from crypto transactions, plus an additional 4% cess. This means when you make gains, the tax bite is significant.
Yeah, and that's not all, huh? There's also a 1% tax deducted at source for many of these transactions, which really adds an extra layer of complexity.
Exactly. The 1% TDS kicks in for transactions above a certain threshold, and it effectively tracks who's buying and who's selling. It's like the government's way of
Indeed.
keeping an eye on the entire ecosystem.
It's really interesting how this intertwines with the idea of transparency, especially since detailed reporting of each transaction is required on the income tax portal.
Right. And this detailed reporting is crucial because the income tax department expects traders, holders, and even those earning income via staking or mining to report everything meticulously.
So, just holding crypto doesn't trigger a tax event, but trading, selling, or converting crypto does.
That's correct. Buying crypto attracts a 1% TDS, while selling or trading triggers the 30% tax on profits. And note, crypto losses can't be offset against other income or carried forward, which is a major point for investors to consider.
Yep. That's a steep reality for many who might expect the ability to balance losses with gains.
Precisely, and it all started when the framework was introduced around the 2022 budget. The Section 115 BBH became a cornerstone for these tax policies, leveling the playing field, or rather imposing a heavy tax load on crypto profits.
I remember there was a lot of buzz online, with memes flying around questioning if crypto was even legal since it became taxable.
Yeah, definitely. The finance minister had to clarify that while crypto isn't considered currency or an asset with intrinsic value, its transactions are taxable. And that really set the tone.
It's like they're saying, we're not endorsing crypto as a regular currency, but if you make money off it, we're taking our cut.
Exactly. And it's interesting because this approach helps fund specific government initiatives like education or healthcare through that 4% cess levied on income from virtual digital assets.
So really, it's a way to both regulate innovation and generate revenue.
Right? And the definition of what qualifies as a virtual digital asset or VDA in the Indian Income Tax Act is pretty broad, covering everything from cryptocurrencies and NFTs to tokens and CBDCs.
That broad scope is what caught my attention. It means almost every digital asset transaction is in the sights of the tax authorities.
And on the topic of transactions, different types get treated differently. For instance, trading one crypto for another is still taxable, and so are special events like airdrops, where the fair market value of the token at receipt is taxed.
Now that's an important point. Even if you're just receiving tokens via an airdrop, you're looking at a 30% tax right there, and then if you sell later, more taxes pop up on the gains.
Yes, it really forces investors to keep good records of every single transaction. Speaking of records, there's a whole process to filing your crypto taxes properly on the Indian Income Tax Portal.
Yeah, that filing process seems daunting at first glance. Can you walk through it a bit?
Sure thing. First, you need to gather all your documentation, trading history, receipts, anything related to crypto income. Then you log into the income tax portal with your PAN. If you don't have an account, you get one set up.
So, this system essentially demands that investors report their crypto trading under a dedicated schedule, right?
Exactly. Most crypto trading falls under ITR2 or ITR3 forms, and you need to fill in details like acquisition cost, sales proceeds, and even income from staking or airdrops under your other sources section.
That seems like a lot to track manually, though. Don't you think a lot of people might struggle with that level of detail?
Absolutely, and that's one of the common critiques. It can be overwhelming. It's like trying to solve a 1,000-piece puzzle without knowing what the final picture is supposed to look like.
And that's where crypto tax software or reliable tax calculators come in handy, right?
You got it. These tools help collate your data and calculate gains and losses, ensuring that all these 30% tax cuts, 1% TDS, and that pesky 4% cess are properly accounted for.
Let's not forget that even though the tax is quite high on profits, some transactions are tax-free. Like, for example, just holding crypto or transferring between your own wallets.
Exactly, and also small gifts like crypto gifts valued up to $50,000 from friends and relatives or from immediate family aren't taxed either.
Right. That definitely provides some breathing space for casual holders or new entrants into the crypto space.
True, but on the flip side, if you lose your crypto or it gets stolen, the tax implications are murky. The income tax department hasn't given a clear ruling on that, so unfortunately you can't claim those losses as a deduction.
That's a bit strict, especially compared to some other losses that are typically deductible in other financial realms.
It does seem a bit one-sided, right? Investors might feel that it's unfair since lost or stolen assets could really hurt overall gains.
Yeah, I see that. So, do you think this could potentially stifle crypto innovation in India?
Well, that's been a point of contention. Some industry experts argue that the high tax rates and strict TDS policies might dampen the growth of the crypto market here.
I can see where they're coming from, but it also signals a matured regulatory system aiming for transparency and investor protection.
Exactly, it's a balancing act. While the regulations can seem draconian, they are also intended to streamline crypto operations and integrate them with the larger financial system.
And it's not static. With evolving global frameworks and discussions around a possible digital rupee, the future might offer some changes too.
Right. As India aligns more with international standards, we might see adjustments to the 1% TDS or even tax rates that could provide relief to crypto traders.
Indeed. It's kind of like watching a new tech ecosystem grow. Growing pains are inevitable until regulation catches up with innovation.
Absolutely. And if you're trading in crypto, staying informed and keeping accurate records is like your best defense against any nasty surprises during the filing season.
Yeah, totally. And just to sum up, for anyone involved in crypto, understanding these tax rules is not optional. It's a must to avoid penalties and keep your investments clean.
Precisely. Whether you're trading, staking, or just holding, meticulous record keeping and timely filing are the keys. And while the tax landscape in India might seem a bit unforgiving right now, there's potential for refinement in the future.
Right. Thanks for this deep dive. It's certainly made the complex world of crypto taxation a lot clearer.
Thanks. And remember, folks, staying ahead means being informed. So keep tracking those transactions and file on time.